Picture this. You are living in a massive fortress, and that is the US economy. The towering walls are built out of solid gold, and sitting on top of them are the most powerful military cannons in human history. You stand up there, looking down at the world, confident that you are invincible. But there is a fatal little secret. That golden wall doesn't belong to you. It is borrowed from the guards, the outside merchants, and even borrowed from your very own enemies. Now, what would happen if on one fine morning, they all showed up at your door at the exact same time and demanded that gold back? Welcome to the Capital Anatomy channel. In today's video, I want you to realize that the US financial system is way more fragile than you think, and how a shift in it will directly tear into your wallet. 1. The unrivaled armor and the Achilles heel. If you treat the global stock market like a giant shopping mall, then the US shopping district takes up almost half of the total floor space, owning all the flashiest signs. Tariffs are being brought out and used like heavy-duty weapons. The US is ready to swing this tariff hammer straight at anyone, from their fiercest rivals to gentle neighbors like Canada or their tight-knit friends in Europe and Japan. At this point, you have seen the absolute peak of power. But behind it all is a truth that very few people talk about. Look down at the foundation of that fortress. The total US public debt just blew right past the $38.76 trillion mark. The debt to GDP ratio has shot up to around 122%. This isn't just some dry number on your TV screen. This is the absolute highest peak since World War II ended. Let's do a little math here. Take that entire massive pile of debt and divide it equally among every US citizen currently breathing air. The result is that each of us is carrying around $110,000. It is exactly like every man, woman, and newborn baby who just opened their eyes to the world, hasn't even let out their first cry yet, already finding a six-figure bill slapped right across their forehead. What a fantastic way to start life. This matters because it leads us to a classic paradox. How can we be drowning in debt like that, yet the US economy hasn't blown up? The answer lies in the mechanism of exorbitant privilege. It plays out incredibly simply. The US borrows debt using the exact same currency it prints, and the rest of the world is just thirsty for it now. They voluntarily hoard US dollars, they trample over each other to buy US Treasury bonds just like people staying up all night hunting for Taylor Swift tickets. The dollar currently makes up almost 59% of global foreign exchange reserves, 64% of the world's debt, and has its name on 54% of all trade invoices. Thanks to this magic trick, we spend money like there's no tomorrow, running massive deficits year after year, yet we are still living the good life because the whole world is voluntarily paying off our debt for us. When you break down the US debt picture, you will see the arrival of new players, and the picture is quietly shifting its colors. While China is tiptoeing backward and slowly cutting down their stash of US bonds, another bizarre force is rushing in on a shopping spree: crypto, specifically stablecoin issuers. Just in 2024 alone, they scooped up an extra $40 billion in Treasury bonds. As of right now, massive giants like Tether are hugging onto more than $127 billion in US government assets. To give you a better picture, a crypto company is now just casually kicking its feet up on the desk, sitting in the seat of the 18th largest creditor to the #1 superpower in the world. What an absolute privilege that only applies to US debt. 2. The bank of the world and the most important commodity on the planet. To understand how the US turned into a giant bank for the entire world, we have to talk about their core product, Treasury bonds. Basically, the US Treasury issues IOU notes with a simple promise. You hand the government a pile of cash. The government tears off an IOU for you that says, "You lend me money, I promise to pay you back in full plus a little bit of interest." It is exactly like an IOU from that uncle of yours who always asks for small loans. The only difference is that this uncle owns a money printer, has a massively powerful legal system, and hasn't stiffed anyone on a debt for over 2 centuries. This matters because it creates the very backbone for the entire global financial system called the risk-free rate. Your mortgage interest rate, the credit card limit you keep swiping every weekend, the returns on the stock market, and even whatever dog or cat meme coin is bouncing around on the internet. All of them are priced based on one single question. If I buy US government debt without taking on any risk, then what percentage do I need to demand to accept the risk of investing in something else? US debt is the exact anchor keeping the entire system of all other investments from floating off into space. Up to this point, you have seen the power of this piece of paper. But next, you are going to see things get a bit more complicated when we look at the map of creditors. We constantly hear the news blabbering about that massive gross debt number of $38.76 trillion. But that is a slightly gimmicky perspective and easily sparks panic. Within that giant chunk, there is about $7.64 trillion that the government actually owes to its own agencies. It is just like you taking money out of your left pocket, putting it into your right pocket, writing it down in a notebook, and then calling yourself a debtor. The part that actually means something, the part that ties the US to the outside world, is called debt held by the public, and that falls right around $31.13 trillion. This is the real number that shapes the interest rates out there in the market. But here is where things start getting juicy. What percentage of US power is held by outsiders? The latest data shows that foreign countries are hugging onto roughly $9.27 trillion. Imagine that number equaling about 31% of the debt held by the public, or around 24% if you are looking at the whole giant gross pie. And who are the biggest spenders on this list? Sitting right at the top is none other than our best buddy Japan, holding on to a solid $1.185 trillion. Following right behind is the UK, with $866 billion. As for China, a thorny geopolitical rival to the US, even though they have been trying hard to bail out and sell off over the past few years, they are currently still stuck with around $683 billion in US debt. So the trillion-dollar question is, why does the whole world, including both allies and rivals, obediently hand their money over to the US in exchange for these IOU notes? That trust didn't just pop up out of nowhere. It was built upon a perfect machine made of 3 gears. The first gear is the unimaginable scale of the market, with over $30 trillion floating around, ready to be traded. The second gear is liquidity. The liquidity of US debt is so massive it's almost funny, with the average daily trading hovering around the $1 trillion mark. Let's try a simple math problem. If you put $1 million house up for sale on a Tuesday afternoon, let's see how many months it takes for you to hold cold, hard cash in your hands. But what if you want to sell 1 million, 10 million, or even $1 billion in US bonds? Congratulations! It only takes you the exact time of a mouse click, and the price doesn't even budge an inch. Finally, there is a fierce belief in the institutional system. The world believes in an independent Federal Reserve, believes in a market where the rules of the game are laid out loud and clear, and above all, believes in the absolute supreme power of a dollar payment system that is dominating this planet. But trust is not a boulder. It is more like a pane of tempered glass, totally transparent, incredibly sturdy, right up until a tiny crack appears. 3. The fracture of trust and the capital war. The global atmosphere has shifted into an incredibly suspenseful state ever since earth-shaking moves were rolled out from inside the White House, under the heat of President Trump. To understand why countries are starting to look at US debt and the dollar as a dangerous leverage instead of an absolute safe haven, we have to talk about policies with breathtaking destructive power. The tension isn't just focused on rivals. Even nations that signed blood brother pacts, like NATO allies, have also fallen into a state of panic. When President Donald Trump made public statements that protection is no longer free and guaranteed, Article 5, the joint defense backbone of the entire NATO bloc, suddenly turned into a dangling question mark. When the idea of buying or taking Greenland blew up, not even ruling out hardline solutions, the world was left stunned. Not to mention the unprecedented heavy-handed decisions on the diplomatic and judicial fronts regarding other international leaders, specifically like the case in Venezuela. This matters because it leads us straight to the most terrifying consequence of this whole story: the weaponization of finance. Have you ever heard of something called the International Emergency Economic Powers Act, or IEEPA for short? It hands the president limitless power, the ability to freeze assets and meddle with transactions whenever a national emergency is declared. Picture it like this. If your entire retirement savings are sitting inside a neighbor's safe, and you know full well that he has the right to change the passcode or confiscate everything with just a signature whenever he gets sick of looking at you, how would you feel? This is exactly how the US swings the big stick of the Office of Foreign Assets Control. And this is the moment the world shockingly realizes leaning on the dollar is no longer a safe protection racket. It has turned into the most fatal strategic weak spot. And reality in the market is starting to reveal some truly spine-chilling signs. Some pension funds up in Northern Europe are quietly making moves. Try looking up info on institutions like Denmark's Lærernes Pension Fund. Just recently, they quietly dumped around $560 million in US bonds, packed up their briefcases of cash, and hopped over to buy German government bonds just to find some peace and quiet. In the same string of events, some reports pointed out that this country's pension fund also quickly ditched over $100 million in greenback assets. And the threat going by the name of de-dollarization is stepping on the gas harder than ever, spearheaded by China and emerging nations. In 2021 alone, Beijing set a record by dumping more than $340 billion off their pile of US Treasury bonds, and there was even a month where they frantically fire-sold $5.1 billion in Wall Street stocks. This trend of rejecting US debt is dragging on without a break, as data shows China continued to pull their foot out from the $765 billion mark down to just hovering around $683 billion in a recent short period. So where are these billionaires and superpowers taking their cash if they aren't buying US debt? The answer is gold. The World Gold Council confirmed that for 3 consecutive years, central banks have been buying up over 1,000 tons of gold a year to stockpile, sending gold prices rocketing to the moon, with some banks even betting that gold will pierce right through the $5,000 threshold in the very near future. The world is getting more and more reluctant to buy your bonds, even turning their backs and selling them off. In your opinion, will the de-dollarization movement actually kill the US currency, or is it just a psychological tactic? Let me know your thoughts down in the comments. Alright, now for the big question. If trust shatters and people actually stop buying or start racing each other to dump US debt onto the market, what would happen? 4. The collapse scenario, when the world sells off all US debt. To understand exactly what would happen if the world stopped buying or aggressively dumped US debt, I need you to picture a seesaw on a kid's playground. On one end of the seesaw is the price of the bond, and on the other end is the yield or the interest payout. When the world starts a race to toss their bonds out to sell, their price will take a brutal dive, and the other end of the seesaw will get catapulted straight up into the sky. Yields skyrocket, and when yields go up, that means the US Treasury has to offer a significantly higher interest rate at the new auctions just to have any hope of someone wanting to buy them. The reality is, you don't even need the whole world to hit the fire sale button all at once. The enemies of the US don't even need to trigger any sort of financial nuke. All they really need to do is cross their arms and be a lot less enthusiastic about buying new debt. Here is the first scenario: the buyer's strike. When the world turns its back, the burden is forced to be dumped onto the shoulders of domestic investors, banks, or even worse, the Federal Reserve has to sneakily print money to buy back its own debt. When the cost of capital gets anchored at terrifyingly high levels for a long time, it creates a phenomenon called secular stagnation. The economy at this point is like a swimmer getting a 50-pound dumbbell tied to their leg right before jumping into the pool. But this isn't even the worst part. What happens if the market starts ringing out early death knells? Welcome to the second scenario, the failed auctions. In the financial world, there is a group called primary dealers. Think of them as contractors forced by the government to buy up the entire leftover batch of unsold bonds that nobody else even wants to look at. Normally, they just pick up a little bit. But back in April 2024, during a $39 billion auction for 1 0-year debt, things went so bad that these dealers had to close their eyes and swallow around 24% of the issued debt. When these reluctant trash cans have to hold on to too much inventory, that is the clearest proof that the actual, real buyers out there are running for the hills. Next up, you will see the third scenario, the doomsday scenario, a mass fire sale. It would be incredibly rare for the entire world to sell off all at once. It usually kicks off with a chain reaction. First comes a geopolitical shock, followed by bond yields violently jerking up, leading to margin calls, forcing giant investment funds to blindly dump everything just to cut their losses, and eventually panic swallows it all. This matters because it will trigger what economists call the doom loop. The 10-year yield is currently hovering around the 4.5% mark. If you add this interest rate to trillions of dollars in deficit every year, the interest payment cost will get blown up to the $1.8 trillion to $2.1 trillion level by the year 2035. It is just like you constantly having to roll over your credit card balance to pay off old debt, but the bank triples your interest rate on top of it. The truth is, right in the 2025 fiscal year, the net interest of the US already slammed into the $971 billion mark. For the first time in modern history, we are spending more money on an invisible math equation than what we spend on the entire mighty military or the Medicare program. Can you even believe that? Let's do a simple math problem. Take the $31 trillion of public debt out in the market If the interest rate merely inches up by 0.1%, the government already has to break its back, paying an extra $31 billion in interest every year when these debts get refinanced. By now, you see that government debt is truly terrible. But how does something happening all the way in Washington crawl right into your wallet? When the US Treasury has to pay high interest, everything around you gets more expensive. Mortgage rates go up, student debt goes up, and auto loans or swiping your credit card becomes suffocating. You should know that US consumer debt has ballooned close to the $19 trillion threshold, 2.5 times higher compared to 2 decades ago. This is called the crowding out effect. When the government rolls out a massive vacuum cleaner to suck all the cash dry from the market just to save itself, small businesses and startups will get starved out, completely unable to borrow a single dime, and eventually, they will have to lay you off. And here is where everything is about to drive off a cliff. Your attention needs to be pointed at the maturity wall during the 2026 to 2027 period. There will be about $1.26 trillion of corporate and commercial real estate debt maturing. It won't just be the government, but every building owner, every single company drowning in debt will have to race each other to take out new loans at cutthroat interest rates, all at the same time. Tragedy always strikes when everyone tries to rush through a narrow door during a fire. Hearing all that, you might ask yourself, then why don't Europe, Japan, or China just gang up, sell off all their bonds, and squeeze the US to death once and for all? This is exactly when the concept of mutually assured destruction comes into play. 5. The price of mutually assured destruction. Let me explain to you why pulling the trigger on the US debt weapon is so difficult. This concept in the Cold War was called mutually assured destruction. Imagine Japan or China. The guys hugging onto trillions of dollars in US debt are like two men standing waist deep in a room filled with gasoline, and one of them holds up a matchstick, threatening to burn everything down if the US doesn't back down. It sounds really badass, but there is a basic physics problem. You can't burn your enemy alive in a pool of gas without getting roasted yourself. Here is the actual mechanism. If a superpower decides to dump their treasury bonds to punish the US, that massive selling volume will send bond prices into a freefall on the market. And because they are still hugging onto a giant pile that they haven't managed to sell off yet, they will have to eat that price drop loss immediately on their books. They are practically burning down their own country's stockpile of blood, sweat, and tears. On top of that, if you just scooped up $1 trillion in cash from selling off US debt, where are you going to put it? This world simply does not have another safe out there that is big enough, safe enough, and liquid enough to hold that massive amount of money. Gold is way too small in scale, and as for the euro, the market just isn't deep enough. Next, you will see things get even more complicated at the execution hurdle. Not every government holds all of those bonds. The majority of that debt sits in the hands of private pension funds, banks, and their domestic financial institutions. If the government forces these institutions to fire sell US debt at a brutally steep loss for political reasons, they will completely wreck their own domestic financial system before they even manage to leave a scratch on the US. Not only that, there is also the most fragile point in the system that very few people realize: the financial plumbing. Let me tell you about something called the basis trade. There are hedge funds doing something that feels like picking up rusty pennies right in front of an oncoming steamroller. They buy physical bonds and sell futures contracts to pocket a microscopic spread, so tiny it's almost invisible. To pick up a lot of pennies and make billions, they use massive leverage by taking out short-term loans in the repo market. It is estimated that the scale of this leverage game reaches up to $1.85 trillion. This matters because Treasury bonds are the most important collateral asset on the planet. It's just like the property deed you use to mortgage at a bank. When a shock hits and causes bond prices to drop, creditors immediately start calling and screaming at these funds to cough up more collateral, which is what we call margin calls. Since they don't have the cash, the funds are forced to dump their bonds at any price just to pay off the debt. The more you sell, the lower the price drops. The lower the price drops, the more collateral you have to pony up, leading to a straight-up panic spiral. A Federal Reserve report pointed out that back in March 2020, hedge funds panicked and net sold roughly $173 billion in Treasury bonds just to save themselves, an unprecedentedly massive number that narrowly missed creating a mini version of the 2008 financial crisis. Up to this point, you see that manipulating US debt is playing with fire. Do you think that any superpower out there is willing to completely toast their own assets just to watch the US bleed? Leave a comment and let me know your thoughts. In short, everyone can threaten to shoot, but pulling the trigger could blow up the entire room. So is the US completely helpless? 6. The life-saving armor, the dollar smile, and a wake-up call for you. Of course, the US fortress has its own defensive weapons. The Federal Reserve has a tool called the Standing Repo Facility, specifically used to pump in emergency liquidity and block the pressure of rising interest rates when the money market goes bone dry. They also set up swap lines, fully ready to toss dollars over to allied central banks when the world needs them. Over on another front, the US Treasury itself also bumped up the scale of buying back its own bonds to the tune of $150 billion a year, just to smooth out the market. The most fascinating part is an economic paradox called the dollar smile. This concept operates in an incredibly ironic way. When the world sinks into a panicked crisis, instead of running away, investors scramble to find the safest possible bunker. And that bunker accidentally turns out to be the exact same US dollar. At that moment, the dollar skyrockets in value, forming the upward curve of a smile. But this smile is not immune to the slap of reality. If the fire of the crisis stems right from the rot inside America's own fiscal and political discipline, the market isn't going to just blindly buy in anymore. They are going to demand a massive risk premium just to agree to hold your assets. These cracks aren't just in our imagination. Right at the World Economic Forum in Davos, billionaire Ray Dalio stood up and fiercely warned about a capital war, where the risk of the system shattering happens when the world loses its appetite for buying US debt. President Trump himself, after his impulsive remarks about buying Greenland, also had to stand on this very stage in Davos to walk it back and backtrack, confirming he wouldn't use military force. It is crystal clear that the upper elites perfectly understand the limits of their own power. Actually, today's story isn't about the scenario where everyone wakes up and collectively trashes US debt. That scenario only exists in Hollywood movies. What is truly happening is that the world is starting to reprice their trust. The global financial system is being stretched like a rubber band way past its breaking point. We are stepping into an era where trusting the US system is no longer a given or completely unconditional. And before we part ways, there are 3 core takeaways you need to frame and hang up on your wall. First, trust is a real asset, and it directly prices out the amount of money you have to pay every single month. The bond market isn't just some distant theatre play showing on Wall Street. It is the literal installment bill for the house you're living in. It is the loan for the car you are driving. Second, leverage is what kills the system the fastest. All it takes is one tiny shock in trust, combined with the massive leverage of hedge funds, and the system will automatically choke itself out before any enemy even gets the chance to fire a shot. And finally, for you and me, diversifying and keeping a solid, liquid cash flow for ourselves is way more important than guessing every sensational headline on the news right. Have your emergency fund ready, completely knock out those high-interest debts, and stay disciplined with your asset allocation. The people who jump into panic trades are almost always the last ones to lose. Thank you for watching the video until the very end. Don't forget to hit the like button, share this video with your friends, and subscribe to the Capital Anatomy channel so we can peel back the truths of how this world works together in the next videos. See you next time.